America's national debt, once just a line item in reports, has now become a looming shadow hanging over the global financial system. According to the U.S. Department of the Treasury, by mid-2025, the nation's federal debt will exceed $37 trillion. This figure is larger than the combined GDPs of Europe, Africa, and South America. If we break it down further, the debt held by the public, the bonds owned by investment funds, banks, and foreign governments still stands at nearly $30 trillion. To put it in perspective, each American citizen, including infants, carries over $110,000 in federal debt. The Congressional Budget Office, CBO, projects that by 2034, this number will rise to around 116% of GDP, a historic high even during times of war. And the cost of this mountain of debt is no longer a distant issue. In 2024, the U.S. government spent nearly $880 billion just to pay the interest on its debt, more than the entire defense budget. For nearly a century, the United States was a symbol of financial stability and security. The world bought U.S. debt as a guarantee from European pension funds to central banks in Asia. Everyone believed that the U.S. dollar would never lose value. But today, that trust is starting to waver, because every financial system, no matter how large, rests on a fragile assumption that the borrower will always pay back their debt. And if that assumption crumbles, what happens then? It's not just a crisis in Washington, but a seismic shock that would reverberate across the globe from Tokyo to London to Shanghai. So the question is no longer, is America in too much debt? The question is, when will this system stop? When the music in the bond market stops playing, who will be left standing? And who will be left to pay the price? In 2008, the U.S. economy plunged into the worst financial crisis in 80 years, pushing the banking system and financial markets to the brink of collapse. The U.S. government had no choice but to inject massive amounts of money into the economy to prevent a complete collapse. They began bailout spending, $700 billion for banks under the Emergency Economic Stabilization Act, followed by $831 billion in tax cuts and relief measures through the American Recovery and Reinvestment Act. In total, between 2008 and 2010, U.S. public debt increased by $2.5 trillion, double the average annual increase before then. Meanwhile, low interest rates during this period allowed the government to borrow cheaply, even at near zero rates. In 2020, an unprecedented shock hit the world. The COVID-19 pandemic triggered a global economic downturn. The U.S. government once again found itself forced to spend heavily to support the people, businesses, and healthcare system. According to the Congressional Budget Office, CBO, these relief packages added more than $5 trillion to the national debt in just 2 years. As a result, the budget deficit as a percentage of GDP surged to alarming levels in 2020 and 2021, around 14.9% of GDP in 2020. The government has consistently pumped money into the economy to sustain growth and social stability. However, these measures cannot continue indefinitely without creating significant costs in terms of interest and debt burden. Therefore, the big question is not just whether America can keep paying its debts, but when the global financial system will reveal its weaknesses. U.S. Treasury bonds have been seen as one of the safest assets in global finance. However, in recent years, we've witnessed a significant shift, a growing wave of fire sales of U.S. bonds, and this is not a good sign. China, which held the largest amount of U.S. Treasury bonds for a long time, has begun to gradually reduce its holdings of U.S. Treasuries. In July 2025, China further reduced its holdings by approximately $25.7 billion, bringing the total down to around $730.7 billion, the lowest level since late 2008. This is not an isolated move. Japan, one of America's largest creditors, also sold off $200 billion in U.S. Treasury bonds in recent months. According to Reuters, other large countries like the UK, Germany, and longtime U.S. allies have also joined the wave of selling U.S. Treasury bonds, with net sales totaling $340 billion in the first months of 2025. The reason behind this sell-off is not just concern over rising interest rates, but also growing doubts about America's ability to repay its debt. If the bond sell-off trend continues, we could face a financial crisis not just in America, but across the global financial system. China, Russia, and other countries have begun pushing for trade in their own currencies, and even gold a strategy to reduce dependence on the USD. This slow but steady de-dollarization trend could lead to a multipolar currency world where the USD no longer holds the dominant position it once did. In particular, China has signed agreements to settle trade transactions in yuan, with several countries reducing reliance on the USD, especially in energy transactions. This marks a significant shift in the global financial order. Every decision in this context has its price. With the weakening of the USD and rising inflation risks, nations and global financial institutions may face sweeping changes in the financial system. To fully grasp the risks of the collapse of trust in public debt and currency, we cannot overlook the lesson from Venezuela. Once the wealthiest country in South America, due to its oil reserves, Venezuela within a decade fell from the heights of prosperity to become one of the poorest nations in the world, facing hyperinflation, default. Venezuela relied almost entirely on oil for its main source of revenue. When global oil prices plummeted in 2014, Venezuela's economy started spiraling into crisis. As production and revenue slumped, Venezuela not only defaulted, but also faced hyperinflation, which soared to an astonishing 929.790% in 2018. The USD became worthless in Venezuela. People had to carry bags of cash just to buy bread, and the value of the bolivar collapsed within less than a year. The US is not Venezuela. It has the world's largest economy, a deep bond market, and the USD is the global reserve currency. However, the Venezuela lesson serves as a warning for the US. After years of rising national debt, the US now faces two difficult financial choices. One option might be cutting spending, but this is not an easy decision. According to the Peterson Foundation, about 60% of US spending is currently dedicated to social welfare programs, healthcare, and other welfare programs. This means nearly 3/4 of the federal budget is locked, making it difficult to reduce without touching citizen rights voters' interests or national security systems. In fact, over the past 40 years, the US government has only achieved budget surpluses without increasing debt for 4 years, while in all other years, national debt has continued to rise sharply. This highlights that cutting spending is the best way to reduce public debt, but it will be a difficult achievement in the face of political interests. Another option is printing money, a short-term solution, but one with long-term risks. Between 2008 and 2020, the U.S. Federal Reserve Fed carried out quantitative easing programs, pumping money into the economy and keeping interest rates near 0%. The IMF estimates that if the USD loses 10% of its value in the next 5 years, hyperinflation will occur, pushing import costs higher and increasing living costs for Americans. This is an uncontrollable scenario if the U.S. continues printing money to repay debt and maintain relief programs. Another option is to raise taxes to increase government revenue. In 2025, upon returning to the White House, President Trump enacted aggressive tariff increases on imports from multiple countries, including traditional U.S. trade partners. The administration justified these measures as a way to protect domestic production, narrow the trade deficit, and bolster federal revenue under immense pressure from a national debt surpassing $33 trillion. While higher tariffs can provide short-term revenue gains, they also raise the cost of imported goods, forcing U.S. consumers and businesses to bear higher input costs. This reduces purchasing power, slows consumption, and risks reigniting inflation. The U.S. faces a serious strategic vulnerability, near total dependence on critical minerals from China, particularly rare earths and tungsten, two materials essential for defense, clean energy, and advanced technology. Since 2015, the U.S. has ceased domestic commercial mining of these materials, relying heavily on imports from China. When Beijing tightened exports in 2024, prices for rare earths and tungsten spiked 40–60%, driving up production costs in U.S. defense, renewable energy, and high-tech industries by hundreds of billions of dollars. This not only increases costs for national defense and clean energy, but also expands the federal deficit, forcing the Treasury to borrow more to sustain industrial and energy security programs. Strategic mineral reliance has effectively transformed into a driver of federal debt. One certainty remains: without genuine debt reduction measures and fiscal reform, the United States risks facing a financial crisis beyond the government's control.